All right, welcome to the February 2023 monthly motor checkup. My name is Dave Lundgren, and I am the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The topic of this monthly video is the wall of worry and how I believe, at least, that it will keep the bears sidelined. This is a diagram or a cartoon that I used to use when I was in my former job, and I also used it quite a bit when I was teaching technical analysis at Brandeis University, and I used to use this to talk about how this is how bears felt about rallies as they unfolded, always labeled them bear market rallies. So this is funny to look at, but I just want to point out that this particular cartoon appeared in June of 2009, which of course was right after the bear market bottom occurred. We got all kinds of momentum crashes, transitions in leadership, and bears fighting it all the way up. So I think it's instructive to think about that concept as we move forward with the possibility, at least according to our risk gauges, that the market has bottomed. So just a quick look at the disclosures for you. So again, the wall of worry will keep the bears sidelined. That's my thesis. There are a lot of things to keep investors uneasy, a lot of things to point to: recession, war, inflation, et cetera. But the market, there's nothing that we can think about that the market's not already processing. As I like to say, the market knows everything we know, knows everything that we know we don't know, but it doesn't know it knows also everything that we don't even know that we don't know. And so that's what I think is the most humbling thing about investing. And it's also why I'm a trend follower, because I believe the market is the best fundamental analyst on the planet. It's the best macro strategist on the planet. And what I'm trying to do is just be the best listener on the planet. And from what I can tell, given all these concerns that that we hear cited in the news, et cetera, the market just doesn't care. It's already digested all of that. It appears, at least for now, to be moving on. How do I say that? Well, the leadership is very cyclical and it's healthy. And the laggards, the stocks that aren't really keeping pace, they actually don't look too bad. And that's a distinct difference between where we are today and where we were in 2022. When you look at the leadership, it's inflation and rate sensitive. That's different. It is what it is, but it's different from the past bull cycle, which was all growth led. Does that mean growth is dead, however? And I've written about this quite a bit in our recent notes, and I think I've probably mentioned it in a video or two, but I want to keep this in front of you because this is actually, I believe, really important. Growth is not dead. It's just that sometimes it's mismeasured by the various index and ETF providers. And I'll show you some interesting charts that I think demonstrate the importance of top line growth and how that will always be important regardless of how others may label individual stocks. So the momentum crash, I've been talking a lot about this, but I can't overstate it because I think it's something that's really confusing and misunderstood. But we just had an epic momentum crash, the worst in the past 11 years, which is how far back I have the data, with the exception of the two crashes that happened during the COVID rally, which of course was Fed induced, et cetera. So aside from those, the momentum crash that we just had is by far the largest we've had since 2011. And so the point is, and I'll show you this, is that the stocks that contributed to that momentum crash in our framework, our checklist of trend change, inviolable rules of trend change framework, despite them doing as well as they have year to date, they're still unviable in our framework. And so the last thing I want to talk about is, if I'm right about this, and if our models are right about this, I should say, that we've begun a new cyclical bull market, then we're going to start to hear things about how extremely overbought things are and how the bulls are back. And so therefore, this is the best short opportunity since the bear market started. And I just want to remind you that I believe it's the opposite, because you don't get overbought conditions in a bear market. You don't get a lot of bulls in a bear market. You get them in a bull market. So with them starting to inflect and starting to get more and more overbought conditions, and the bulls appear to be coming back, just remember that's a good thing. It's not a bad thing, despite what the media will want you to believe. Okay, let's just start with a picture of the S&P 500. We know this is still in a downtrend. We can easily make that argument. With lots of overhead resistance, the market's going to have to chew through all of this resistance, and that's going to just induce further anxiety and uncertainty and I guess bearishness. That's all to be expected. It's unavoidable. You can't put a bear market bottom in and without going through all this churning and getting through resistance. So that's expected. That's the main takeaway. But what I can say is that as this basing period has been unfolding, our risk gauges have been improving since November. This is how they look back in the January video, and they continue to improve. This is where they are today. So 1 month later, we're still at a 6 on the quarterly time frame, but again, that's ticked up from 7, which is our near escape from Armageddon, GFC type sell-off. Weekly and monthly are almost in risk on, which is really critical. That's getting these into risk on is what will pull this further up away from that risk off situation, and eventually, if all goes well, into risk on, and then we'll have all 4 of these timeframes in risk on, which will get us into a nice, vibrant bull market. But the main thing is, while we're waiting for this all to unfold, is to just expect the market to have difficulty getting through here, so that when it does happen, you won't be freaking out, you won't be thinking something's wrong. It's perfectly normal for the market to stall here. What's more important is that while the market struggles with this resistance, it can do whatever it wants as it struggles with this resistance, as long as it stays above here. This is the rising 50-day moving average, which you can see is now above the 200-day moving average, that green line. So really, if we hold above this 3,800 to 3,900 support area, that's really what we need. But ideally, if this is a truly robust bull market, cyclical bull market, we will hold above this rising 50-day moving average going forward. Because we're so early in the turn, it's possible we go back below the 50-day again. In that instance, well, we'll just want to see that the rising 50-day average can continue to rise, and that we don't spend so much time below it that the 50-day average starts to roll over. But that's all, that's a bridge that we'll cross when we get to it. Right now, as far as we can tell, we've seen enough structural improvement to make the base case assumption that this is going to hold. And we are in the beginning of a new cyclical bull market. Okay, so let's take a look at these gauges at the sector level. We can say for sure that the leadership is cyclical and uniformly looks quite healthy. So energy is number 1, industrials number 2, discretionary number 3, financials number 4, materials number 5. That's all cyclical. We can say for sure, obviously it's kind of unfortunate that tech is absent, but that's okay. We don't need it. Remember that from 02 to 07 or 08, which was one of the last cyclical bull markets that we've had in the past 20 years, that entire bull market unfolded without tech participating, without growth participating. So it's possible, certainly definitely possible, and maybe that's what's happening right now. What's more important is that safety is no longer amongst the leadership. If you remember last year, through the notes we were writing, in the videos that we did, energy retained its number 1 spot, which we all know, but up here in number 2 and number 3 was staples and utilities. That's just not bull market leadership. Finally, they've been pushed down into the bottom of the momentum ranks. So staples and utilities are now battling for the lower rungs of the relative performance ranks with technology, media, and real estate. So this is positive. This is a positive development. And when you look at the laggards, I mean, we've actually got a couple of them that are actually in or near risk on in various timeframes. That's completely different from last year. If you remember last year, the leadership looked terrible. It was just less terrible. And of course, everything in the laggards side was all in risk off across multiple timeframes. Today, we have the leadership is cyclical. It looks good. It looks healthy. And the laggards don't look too bad. That's what a bull market is all about. So we're pleased with the way that the leadership is unfolding, and we're happy to accept the leadership as it is, even though it doesn't include tech and media, because we know once again that is a normal circumstance, perhaps following a bubble. And I've made the case in our notes and in these videos that technology, media, and real estate, when you look in the rearview mirror there's probably 3 pretty large bubbles. And much like 1999 to 2000, when that whole bubble imploded, that did not stop another cyclical bull market from unfolding. It was just led by other things: energy, materials, home builders, financials, et cetera. So just keep an open mind to the possibility that that's what's happening today. When you drill down on the industries, again, it's just really, these are the industry ranks from 100 down to 77. So this is the top, I guess, 35 ranked industries. it's once again really with the exception of a couple of maybe healthcare industries that aren't really cyclical as much as they're just growth oriented. Um, you look at this cadre of leadership. It's dominated by mostly cyclical industries. Um, as I've mentioned in the past, I have this relative performance type model, which kind of breaks the market down into strength and safety. And in a bull market, you want to focus on companies that have strength. In other words, that have demonstrated a historical tendency to lead during bull markets. And you want to avoid safety. Safety stocks have a tendency to lead during bear markets, and they have a tendency to lag during bull markets. So when you look at the leadership here, look at the representation of strength stocks in these currently leading industries. This is telling you that the market is beginning to favor strength. And remember, most admired are companies that from time to time this exists in the market. It's not a large swath of the market. Typically, it's only about 5%, but most admired are stocks that have both strength and safety at the same time. And you can see that there's a bit of most admired in the leadership as well. So for me, this is where we want to focus our stock selection, and just avoid things that don't make this cut. In keeping with that strength and safety concept, this was from last month's video, and what I was doing was just showing you how the two different buckets of relative performance type looked from a bottom-up perspective. And back in January, 24% of the strength stocks had a relative buy ranking. So I have a relative model that goes 1 to 10, 1 being best. 10 is still good, it's just not as good. 24% of the strength stocks had a relative buy rank. 44 of the safety stocks had a relative buy rank. So that was a negative 20% spread. So that's obviously an environment that's not conducive to a sustained bull market. And so although we began to see things inflect, we covered all of our short exposure, if not all of it, most of it, and we began to get closer and closer to being fully invested because of other things that we saw inflecting. This was one of the things that kind of held a cloud over the market. But I just want to reiterate where we were back in January. Of all the stocks in the strength sector, 36% had an outperform rank, and 61% had a outperform rank in safety for a negative spread. You can continue to go down the list. This is relative moving averages. 40% of the strength stocks had a rising 50-day relative moving average versus 42 for safety. So pretty close, getting better. This was one of the things we were monitoring. Not as bad as it was, but still negative. Here, percentage of stocks with a 50-day above the 200-day on the relative performance, 32 versus 63, definitely favoring safety. And then the percent with a rising 200 relative moving average, 22 versus 80, definitely favoring safety at the time. But when we were following this over the months, it was still favoring safety, but inflecting more and more towards strength, which is really what we wanted to see. And so much so that as of January, we actually saw more when you look at the spread between the percentage of strength stocks that are hitting a 13-week relative high versus a relative low, last January, it was negative 3%. It was negative 19% for safety. So in the very short term, we were beginning to see a lot of relative breakdowns among safety. So that produced a positive spread here. So that was one of the incremental changes that we saw that really kind of added to our belief that it was right to begin covering shorts and getting more and more close to fully invested. And then as you go down the relative performance timeframes, you can see that it was still negative when you get out to 52 weeks, but definitely getting a lot closer to being neutral. So that's where we were in January. We've seen a big inflection here. So this is where we are today. Still not fully in favor of strength, but you can see a massive inflection. This is exactly what you want to see. You don't see this happen in bear markets. You see this happen in bull markets. There are more relative highs versus relative lows being hit in strength stocks than in safety stocks. In fact, in safeties, the safety timeframes, or I should say in the safety stocks, all of the relative timeframes are all negative. So there are more relative lows being hit in every timeframe than relative highs for safety. So this is exactly what you want to see. And this is important to us because this is one of those inviolable rules of trend following that we really adhere closely to in our research process, as well as therefore in our portfolio management process. This is a concept that is inviolable. You can't have a bull market without it being led by strength stocks. Safety stocks, by virtue of their definition, don't lead bull markets. So the fact that we've seen this inflection tells us that, you know, we may have all sorts of apprehension about recession and inflation and war and all these other things, but this is what the market's doing. And this is why I have chosen to just develop this process that just does a really good job in my mind of listening to the market. And then I just try to do as best job as I can do listening to the market itself vis-a-vis these models. So here's an interesting concept that I wanted to cover because it's starting to make its way through the press as well. And that's something that I've been following in these notes and in the videos. But I think there's a message here that I just don't think is being picked up on as folks talk about this in the media. So we all know the market peaked in early 2022 at the same time that the 2-year note yield began to accelerate higher with the Fed raising rates, the 10-year yield breaking out, and the US dollar index breaking out as well. What we're starting to hear more and more about today is that these things are starting to turn higher again. So that's bad for stocks. That might be true. That might be true. If it is true, it'll start to make its way through our research process and it'll start to show inflections in the wrong direction. But what we can say is that the market knows this. The market sees these trends. It's already processed it. It knows things we don't even know, and it's processing it still. And what's it doing? It's continuing to break out. It's still continuing to rotate to cyclicals, et cetera. So the market sees this. And while there are people that are apprehensive about it, the market does not appear to be, right? And this is potentially why that may be the case. At the same time, the market topped in early 2022. We all know this. Inflation expectations turned higher. But within the equity market, what began to happen is inflation beneficiaries began to outperform the S&P during that almost 30% decline in the S&P. Inflation beneficiaries outperformed. Rising rate beneficiaries outperformed. And this ETF, it's AIRR. It's the American Industrial Revolution ETF. So it's composed of companies that would benefit from political legislature that is put forth to rebuild America, if you will. That ETF outperformed all last year, and that ETF is now at new all-time highs as we speak. So this is what's different about last year versus what led up to the bear market in 2020 to 2021. That was all led by growth, which led the entire bull market off the 2009 bottom. I would make the case that what the market's trying to tell us is last year was a year about rotation into inflation beneficiaries and cyclicals that benefit from rising rates and inflation in an industrial revolution. Much like 2002 to 2007, we had a bull market that was led by similar type leadership. Is it conceivable that we have the same thing ahead of us today, where the market it looks at this potential reacceleration in inflation expectations and continues higher anyway, led by those stocks and sectors and industries that would actually benefit from expanded economic growth and inflation and rising rates, et cetera. So something to think about. I know it's controversial, but I'm just trying to piece together the things that the market appears to be saying to me as best I can. And this is what when I triangulate all the data points that I have, this is what I can come up with. So if we are on the brink of inflation, doesn't that imply that that gold and gold stocks should start to work? Believe me, I have that same instinct. I want to believe that to be the case as well. But I have a few data points that I want to show you that just at this point right now, it doesn't make sense to me. I'm open to it. I'll buy anything that the market tells me to buy. But when you look at this picture right here, I look at this chart and I think of Carter Worth, who's known for saying a pair of twos. I mean, this is just, you don't win poker hands with a hand like this. This is just going nowhere, and it's at the top of the range, and momentum is now all inflecting lower. So, I can't get in my checklist of trend change process. I can't get there with respect to precious metals themselves, gold. If you can get there fundamentally, I would just tell you that you don't have technical support. So just keep that in mind in your position sizing or whether you do it at all. So when you carry that conversation over to the individual stocks themselves, we can see that the 200-day moving average on the gold miners, this is the gold miners ETF, the GDX, 200-day average is still declining. The 200-day average on the relative performance is still declining. So this is just not the thing. This is not the ingredients for bull market leadership. Not to say that these won't someday, but they're not right now. And after all, we're trying to buy what's leading. So if you look at the all the gold names in the motor universe, which is about 2,500 stocks, there's about 30 or so gold names. The best one is ranked 74 out of 100. So that's the best one. And then you don't go too far down the list before you start to get into sub 50 and then all the way down into the low bottom decile motor ranks. And so there's just nothing here for me to endorse from a opportunity perspective. I'm all over it. If the market tells me I should start looking at these names, but as it is right now, I can't get there. Within materials, this is how the industry shapes up. I mean, it's at the bottom of the materials sector. It's ranked 21, as I said earlier. It's 21 out of 100. Looking at the relative performance type components within the gold and silver industry, 58% of the stocks are safety. So they're not even configured to lead a bull market right now. So it just doesn't have the ingredients necessary. There's 38% sells versus 8% buys, so the spread is negative. So it's just, I get it. Inflation, I get it. You should buy gold stocks. You should buy whatever. It's not right now. That's all I'm saying. Maybe it will be, but right now, what you can look at are things that are working in the material space where there is strength right now, where there is some most admired, where there is relative ranking that's positive, and where there's positive, buy and sell spreads. So I'd far rather, for now, within the industrial space, within the material space, I should say, own things that are working, and there's plenty to buy there. And I feature them frequently in the weekly motor reports, which come out every Monday morning. So I thought this was interesting. This came out, I believe it was today, from Research Affiliates. If you're not familiar with the firm, you should go to this website and sign up for the distribution list. They put out some great research. And what they're showing here is that they went back to the 1930s, and they just showed the inflationary decades versus the non-inflationary decades. And they just showed that the value factor tends to generate consistently higher alpha during inflationary decades. So that's something important to think about going forward. If we are indeed stepping into an inflationary decade, probably be mindful of valuation. That makes a lot of sense to me. I've actually shown a lot of charts in support of that in my research notes, as well as in these past videos. But here's something that I want to just don't lose sight of, because I just think people are getting caught up in this concept of growth, and they're losing sight of a very important point that I've brought up a lot in my research, and I've definitely had it reflected in the portfolios I manage. This is another research piece that was written by Oxford Economics a couple of years ago, and their forecast then was that because of the extreme valuations, that valuation should be a headwind to performance over the next 5 years. And of course, it's been a fantastic call. But notice that they also said that one of the big contributors to the returns over the next 5 years will be growth. And that sounds like a terrible call. But I would argue that it's been a spectacular call. And if you've been following my notes and following these videos, you'll know exactly what I'm talking about. If you actually look at where the growth has actually been over the past couple of years, it's actually been in energy. And so what we're looking as an example, it's been in energy as an example. So this is a revenue growth model that I have, and it's simply taking the 2,500 stocks and bucketing them according to their top line revenue growth. So if a stock is in the 50.1, that means that the top line revenue growth has been at least 50%, and the 0.1 means it's profitable. 50.0 means it's been at least 50% revenue growth, but it's an unprofitable company. So what you can do is you can look at this bucket and just look all the way across at the sectors, and just all of these percentages will add up to 100%. And 38% of this bucket, the biggest, most profitable growth bucket, is energy. And there's no energy stocks in growth ETFs and growth indices today. So this is the disconnect between what is happening, boots on the ground, what's actually happening, and what the index providers and ETF providers are telling you, or at least how they're trying to get you to map your portfolio to match growth. And look at here. This is industrials, profitable growth. These three buckets: 10 to 20%, 20 to 35%, and 35 to 51%, 50% profitable growth, dominated by the industrial space. Notice where the tech space is. It's dominating the growth for sure, but it's all unprofitable growth. So when you look at where capital is actually flowing, it's flowing to profitable growth. So what do I mean by flowing? Well, if you look at the medium terms, think about the monthly time frame trend, 59% of the motor universe is in an uptrend, which is, again, if you've been following this along, this is very much an improvement over the past year. This is past several months. This is one of the reasons we covered shorts and got close to fully invested, and now we're fully invested. But here's what I really want to point out. If you look at the percentage of each of these buckets that's in an uptrend, they're all above average for the market. But then you look at the non-profitable growth, and they're all in the percentages in an uptrend in those buckets is less than average. So again, capital is flowing, literally flowing from a trend perspective to where the profitable growth is. So when you're thinking about positioning your portfolio, don't think about what the indices are trying to get you to do. Think about, well, what the ETFs are trying to get you to do. Think about where the growth is. And that's what the market's migrating to. It always does. It always will. And I'm just making the case that the market's behaving as it always does. It's just not really showing up in the way that these ETFs are being mapped. Okay, one last concept before I want to hop into sentiment real quick. This is the gain in the S&P 500 year to date. And most people who particularly follow a trend following process or a momentum process, they're underperforming year to date. I can tell you in my portfolios, I'm underperforming year to date, but I can tell you exactly why, and I'm perfectly comfortable with it. And that's the takeaway here. I want to really stress that what's happening from a momentum and trend following perspective is actually 100% within the realm of expectation. So here we go. The top 50 contributors in the S&P 500 that have contributed to the gain that we've seen so far year to date have contributed 80% of the year to date gain. So if you look at it, 80%, so the market's up about 7.5% or so. So 80% of that return, 636 basis points, has come from, I should say it this way, maybe 36 of the stocks that have contributed 80% of that gain have come from stocks that were started in a downtrend and remain in a downtrend. So that's the challenge. The stocks that have come up off the bottom the most and therefore drove the S&P higher are completely unbuyable in a trend following process. So the whole notion is that you just have to let somebody else make money. Sometimes when as I say here, when your process is out of sync, which trend following in momentum is right now, and it always is at a market bottom. So the fact that trend following and momentum is struggling right now, it's difficult for us as trend following and momentum portfolio managers, and perhaps for investors who are in strategies like that, who aren't being properly coached by their portfolio manager. It's difficult for them. But if you understand it, sometimes you just have to let other people make money. And, I'll take this process over any other process over the long haul any day of the week. But I just know that in the interim, these are the types of periods that I need to be willing to suffer. And it's by no coincidence that the technology has contributed 42% of the year-to-date gain in its 20 stocks, and all of them are still in a downtrend. So that's something some food for thought as you think about what's going on year to date. This is the momentum crash that has resulted from that what I just described, where all these big mega cap stocks that were in a bear market and still are in a bear market come rallying off the bottom, causing the momentum factor to crash as it has. This is the largest momentum crash since 2011, since I have the data, outside of the COVID rally that was induced by the historic Fed response to the economic conditions, and that caused some massive, like probably 5 or 6 or 10 standard deviation momentum crashes. Aside from those, this 23% decline is by far, not even close, the biggest momentum crash we've seen. So just remember, that momentum crashes sound scary, and they are, in particular, as I've just described, for momentum investors, particularly if you're short. By the way, this is why I covered my short exposure, because this, you know that this is going to happen to the momentum factor, so cover your shorts. This is why. This is what you're getting out of the way of, if you will. But remember, this is bullish. This is one of the ingredients for our bullish call. The fact that we're getting historic momentum crash. This is, once everything settles down, the momentum factor gets kind of realigned with leadership, then we'll be off to the races in the new cyclical bull market. That's our call anyway. But in the interim, we need to navigate that, manage our expectations. But just remember that this momentum crash, the very evolution of it, is bullish for equities. Okay, real quick on sentiment, because this is something that's going to start to get a lot of press. I am relatively certain, only because it typically does during the beginning of a new bull cycle. This is what fosters and builds that wall of worry upon which the market continues to build. But now that we're in a new bull cycle, you're going to start to hear things like, this is the most overbought momentum since the bear market started, or we now have the most number of bulls since the bull market started. Well, guess what? That's by definition the start of a new bull market. You actually want to hear these comments, because it's what puts more bricks in the wall of worry. It forces people to hesitate to engage with the evidence that's unfolding before them, because if all these overbought conditions over the past year have been good selling opportunities, then how can the most extreme overbought conditions since the bear market started, how can that not be the best selling opportunity? In a very perverse way, it's actually the first most overbought condition in a bear market is actually a buy signal. It's actually the beginning of a new bull market. And I have a lot of things that I point to, including that momentum crash and other things, all the rotation into cyclical leadership, all these things that I'm talking about point to the beginning of a new bull market. And so now that we are starting to get more bulls than bears for the first time in 62 weeks, by the way, this is, if you look down here, this is the weeks since the bulls were greater than the bears. 62 weeks. That's by far, not even close, the longest run of more bears than bulls on record. The last record we had was 34. And so this is by far the longest run of bearish sentiment. So the challenge with that, with all bearish sentiment, with all these things that are not really those first principles or the inviolable rules of trend following, this is why I follow sentiment, but I don't act on it, because as we learned last year, markets can go a lot lower even though there's a lot of bears. And so this is not a first principle of trend following, but it does help describe the environment. And when those first principles inflect, which I hope you're getting the point up till now that they are beginning to inflect, and you should be adopting more and more bullish positioning, et cetera. When they do inflect, just know that the conditions that prevailed before that inflection planted the seeds for a robust, sustained bull market, because everybody was so bearish. So here's the challenge. If you ignored the fact that the trend remained bearish throughout 2022, instead, you tried to get in early and you tried to buy the low, and you said, well, look, very rarely do we get out past 15 weeks of more bears than bulls. So I'm just going to buy when we get to 15 and see what happens. Well, if you just ignored trend, you went down another 16%. Okay, so let's say you dodged that bullet and you said, well, I'm going to wait till 25 because that's like rarefied air. It just never happens, right? So I'm going to do that. Well, from there, it went down another 12%. And then you said, okay, well, thank God I dodged that bullet, but we are now out at 35 weeks. I am going to start buying, even though the trend has not inflected positive yet. The market went down an additional 15%. So this is why it's critical to pay attention to trend and all these other elements, these 5 elements that I follow that are all reflected in that risk gauge. Remember, it's price trend, relative trend, momentum, breadth, and volatility. Those 5 things scaled across 4 time frames. That's what gets us to our risk gauge. The risk gauge kept us bearish throughout 2022, inflected positive in November, and has continuously got us more and more bullish and optimistic on the market. But you'll notice it's sentiment, presidential cycles, where we are in the calendar, none of that is in the risk gauge, because the market can do whatever it wants, despite the calendar and despite what month we're in and all that, these other things. It's important, but it's not part of the list of things that must happen in order for trend to go from 3,300 on the S&P to to 5,000. If you're concerned about the market going from 3,300 to 5,000 and you're going to miss it, and that's why you bought it 15 weeks of a negative spread, and you were concerned about missing that rally. I can only tell you that from a trend following perspective, you can't go from 3,300 to 5,000 unless you get through 3,200, or unless you get through 3,400 or 3,500. That's a simple concept, but it's inviolable, right? So our entire research process is built on concepts like that. So I just want to put that out there and let you know that this has inflected positive now. And you're going to start to hear more and more about how there's more and more more and more bulls now than there have been throughout the entire bear market. So therefore, this is the best sell signal we've had all throughout the bear market. Spin that notion on its head because it's actually bullish. So here's the positioning. This is from Bank of America, another great research product. I think this came out today, and it's just showing you the net percent overweight in equities minus the net percent overweight in bonds. It's below where it was in COVID, and it's almost down to where it was in the global financial crisis. So these are some pretty extreme environments. This is how we're positioned now. As you can see, they were getting more and more bearishly positioned for quite a while now, but it didn't matter. Even positioning doesn't matter in that risk gauge, because you can see here that the market can keep going down as people get more and more bearish. But now that the trend has inflected, the risk gauges have inflected. This is the background that prevailed before that inflection, which now gives us an environment with plenty of fuel to burn for this bull cycle before we run out of fuel. So one of the big things about the coming year is this notion of recession. And I don't know. I'm not an economic strategist, but I have said several times that I think the market is the best economic strategist on the planet. So that's why I listen to the market, right? So I don't know if we're going to get a recession. Maybe we do, maybe we don't. But if we do, here's the thing. Is it reasonable to suspect that if everyone expected the recession, then so too did the market, right? Do you think that the recession is going to sneak up on the market when everybody else was expecting it? I would say no. So is it possible that this decline was all about the market discounting whatever recession is coming, and the reason it's going the other way is because it's looking past that value to the next cycle, which is led by inflation beneficiaries, rising rate beneficiaries, industrial renaissance, et cetera. So this chart is just showing you the Google search for the word recession back to the year 2004. And this is the global financial crisis. So obviously lots of people searching for the word recession. This is COVID, not surprising. A lot of people, I mean, that was a dire economic condition. And look at the spike in those searching for the word recession during this recent decline. So I got to believe that this is at least one data point saying that this recession is one of the most expected, anticipated recessions ever, at least certainly in most recent history. And if that's true, isn't it reasonable to expect that the market already discounted it, and that's why the market's inflecting the other way? And we should be thinking about the economic environment beyond the recession if we do even get one. So something to think about. It's what the market's saying. It's what I'm saying because the market's saying it, and something for you to think about as you're thinking about your posture versus the market and your exposure versus the market. Okay, so let's sum up real quick. Leadership is cyclical, happens to be inflation and rate beneficiaries, but it is cyclical. But I want to stress once again that it's also growth. It's just not last cycle's growth. So whatever's leading right now, I showed you it is growth. Just because the ETFs and indices providers are not saying it's growth, I don't know what to tell you. This is the boots on the ground, what's actually happening. This is where the best top line revenue growth is taking place. I actually have some charts on my website. If you go to the philosophy tab, you'll see a bunch of charts in there that show what drives long-term performance of individual stocks. And by far the biggest driver is top line revenue growth, happens to be happening in industrials, in energy. And so let's just position that way. This epic momentum crash that we just had is one of the many factors that we monitor contributing to our bottoming call. It's just that the things that contributed to that momentum crash, we can't buy them. They're all those bouncing, broken bubble charts. And so we have to just let other people make money owning them for now. And if we can start checking boxes that we should own them down the road, we will. But until then, we're not going to. My suspicion is we won't. But keeping an open mind. So as I said earlier, we covered all of our shorts in December and January. But those who disagree or those who want to keep short exposure on because of their mandates should shop here for their short ideas, these bouncing broken bubble charts. So I would search in this area, and I would also search in those safety stocks. And the most neglected, remember, are stocks that lack both strength and safety at the same time. So they basically stocks that can't get out of their own way. So that's where I would look for short ideas. If you want some short ideas, please, by all means, reach out to me, and I'd be happy to hop on a call with you or send you some ideas. But that's where I would look for them today. And then remember, as we go forward, the talking heads will, if all plays out as it typically does, we'll start to talk about maximum overbought and more bulls than bears since the past year. Those are all things you want. And in fact, the more, the better, because that confirms that the lows are in. And so that the reason being, because we're in a bull cycle, and bull markets don't happen without bullish behavior, and they don't happen without extreme overbought conditions. And so this is what we're going to be looking forward to as the bull cycle unfolds. And I would just encourage you to reach out to me if you have any questions, or you have you want to run through any portfolio reviews or anything like that. I'm here to help in that manner. So looking forward to hearing from you and keeping in touch with you in our weekly motor reports. Thanks for your time.